In this episode from Macro Horizons, Ian Lyngen and Ben Jeffery bring you their thoughts on the U.S. rates market for the upcoming week of February 2nd, 2026, and respond to questions submitted by listeners and clients. Let's dive in.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
This is Macro Horizons, episode 359, Powell, then Phil, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of February 2nd. Groundhog Day is on Monday, and given the winter that we've had thus far, it's safe to say that we're all hoping for an overcast day in Gobbler's Knob, or at least a very large sun umbrella. In the week just past, the most relevant developments were things that didn't happen. The FOMC didn't cut rates, and the president didn't announce his selection to replace Powell. What did happen was that the FOMC statement indicated a slightly more optimistic take by the Fed in terms of the outlook for the real economy and some further stabilization in the labor market. Specifically, the statement upgraded the characterization of the pace of growth from moderate to solid and removed the language that said the committee judges that downside risks to employment rose in recent months. Now, there were two dissents, one from Moran and one from Waller. Bowman voted in line with the decision, which isn't particularly surprising. Nonetheless, it's clear that there continues to be divisions on the committee, and we anticipate that that will be a theme as 2026 unfolds. Powell used the well-tested meeting-by-meeting decision framework when asked about how the Fed might be thinking about the March meeting. And the biggest takeaway from the press conference was Powell's statement that after the three recent cuts, we're well positioned to address the risks that we face on both sides of our dual mandate. Now, clearly, the return of tariff talk has made reflationary concerns top of mind, although, in light of the relatively benign inflation figures that we've seen over the course of the last several months, it does seem that the pass-through of tariffs to the end user haven't been so dramatic as to recast the aggregate CPI or core CPI numbers to a higher plateau. Powell did make the observation that there has been tariff pass-through and that the committee was encouraged by this insofar as service inflation has been moderating, and seeing tariff pass-through prop up certain prices within the core CPI basket isn't inconsistent with the Fed's longer-term objectives, because at the end of the day, monetary policymakers are continuing to frame tariff pass-through as a one-off price adjustment as opposed to true demand-driven inflation that would warrant a monetary policy response. There wasn't much of note on the data front, and the auctions went reasonably well. The initial jobless claims figures came in at 209, a slight increase from the prior week, but certainly nothing that would get investors concerned that there's going to be an upside surprise in the unemployment rate anytime soon. In terms of the performance of the Treasury market, the theme was range-bound. After recently peaking at 4.3%, 10-year yields have drifted back down and found an anchor at the 200-day moving average of 4.23. We anticipate that this level will create something of an anchor for the market until we have further clarification on the performance of the labor market during January. Presumably, this comes via the February 6th release of non-farm payrolls.
Well, we got a Fed meeting, and it was generally as expected. There was no SEP, so little excitement in terms of the central bank's formal economic forecasts, and policy rates were left unchanged, with some dissents in favor of a rate cut, although not as severe dissents as we've seen recently. The most significant takeaway from the FOMC came in the form of Powell's press conference, where the chair struck a relatively more optimistic tone on the state of the economy versus what we had been hearing over the last 6 months or so. Both within the press conference and the language of the formal statement, we saw that the Fed no longer sees downside risks to the labor market as accelerating, and while this doesn't undo the softening that we've already seen over the past 6 to 9 months, it does suggest that looking ahead, the worry about a greater erosion in terms of the pace of hiring or a more significant increase in the unemployment rate has moderated to a degree. In keeping with the optimism theme, Powell also was encouraged by the state of the consumer, by the health of consumption, and what is broadly expected to be not only a strong read in terms of Q4 GDP, but also a generally robust economic outlook for the first half of 2026. Has this taken a March rate cut off the table? No, but at least versus where we were in December, the messaging delivered from the FOMC has certainly conveyed far less urgency to bring rates lower in the near term.
And that follows intuitively. After all, by leaving policy rates unchanged, the committee has effectively communicated that the situation has improved versus where it was in December, and therefore it shouldn't have been surprising to see the Fed's tone shift. And in fact, that's precisely how the market traded it. Both 2- and 10-year yields remain in a very tight range and, to a large extent, took very little direction from the FOMC. There was another key risk that appears to have been delayed until next week or beyond, and that was the announcement of Trump's nomination to replace Powell. As it currently stands, the top contenders remain the same. They are Reeder, Warsh, Hassett, and Waller. While it's clearly difficult to anticipate the way in which the administration comes down on the issue, investors at the moment appear biased toward either Reeder or Warsh. Again, as the news cycle develops, and presumably we will see another trial balloon or two from the White House, the market will likely be given an opportunity to further refine expectations. We continue to assume that a Reeder nomination will translate into a bid for duration and a flatter curve, whereas a Warsh nomination would benefit the front end and presumably steepen the yield curve. But given the recent price action, we suspect that this would all occur well within the current range. The more relevant risk at the moment is the evolution of the employment market. Clearly, Powell has communicated that the Fed is seeing signs of stability. Now, that doesn't mean a roaring back of jobs growth in Q1, but stability is better than further deterioration for sure. Whether or not the January payrolls report reveals solid job creation is the wild card and likely to be the looming factor that keeps yields in the prevailing range until the information is known. And it's important to keep in mind that there's another key uncertainty, and that is whether or not we see a partial government shutdown. A partial government shutdown could potentially take the BLS offline again, which would delay payrolls as well as the economic data that the BLS has already collected. We're somewhat optimistic that we won't have a repeat of what happened in Q4, but it is certainly an issue that's on the radar as the weekend comes into focus.
And returning to the Fed chair conversation, which, particularly if we get a delay in economic data releases, will likely play an outsized role in the market discourse over the next several weeks, there is another dynamic we've heard discussed as it relates to the potential Warsh versus Reeder nomination, and that is what a Warsh nomination would imply about central banking independence, and given the politicalization of the Fed we've seen during the first Trump administration and the second Trump administration, a Warsh Fed could be viewed as a vote of confidence that monetary policy decisions are not going to be unduly impacted by pressure from the White House. Now, the other side of this argument is that, given what we know about the president, that probably makes his nomination less likely than some of the other candidates. But in thinking about potential nominees outside of Rick Reeder, whether it's Warsh or Waller, two people that have spent the bulk of their careers at the Fed, an institutional Fed chair does run the risk of being interpreted as, at least relative to current market pricing, a bit more hawkish than a Fed chair that would probably be more beholden to the executive branch's wishes. Now, that's certainly a discussion that will need to be had after we finally get the announcement of whoever Powell's replacement will be. And in the interim, to your point, Ian, the durability of tens within striking distance of 425 is going to be much more a function of how the labor market performed to start the year. If we've got another month of low hiring, low firing, that's probably going to embolden the status quo and likely add greater weight to this current range we're seeing in treasuries and what seems like a risk asset environment that remains constructive given the fact that the Fed and Washington seems to want to keep running the economy hot. And that, all else equal, should be good for stocks.
Another interesting dynamic that played out in the week just past was we saw the U.S. dollar depreciate to levels not seen since February 2022. The sharp sell-off in the dollar reinforced the dollar debasement narrative and is consistent with gold at record high prices, the general rally in commodities, and renewed concern regarding the dollar status as a reserve currency. What is particularly fascinating about the price action was that move didn't translate into a spike in Treasury yields. In fact, 10-year yields remain comfortably below the 430 peak, which represents the local high. So as the Treasury market continues to consolidate ahead of what we hope will be non-farm payrolls Friday, we'll be watching for any evidence of a return to the sell U.S. asset sentiment that has been episodic over the course of the last several quarters. The same can be said about the U.S. equity market, which set fresh highs as the S&P 500 topped the 7,000 level for the first time, and as a theme as we go through earnings season, sentiment in the equity market remains positive, to be sure.
And government shutdown or not, which holds the potential to delay NFP, we will be getting February's refunding announcement next week, kicked off by the financing estimates on Monday afternoon, where no change to coupon auction supply is expected, but that won't prevent greater detail on how Besant is thinking about the issuance profile of the market going forward from being revealed, whether that's in the report to the Secretary or the minutes of the refunding meeting, maybe something within a T-back charge, as one of this cycle's bigger surprises, from our perspective, continues to play out. What we mean by that is the much more dynamic and active management approach to regular and predictable issuance, as Trump's goals to get 10-year yields and ultimately mortgage rates lower are flowing through to the market via the Treasury Department, and a reluctance to increase long-end auction sizes. We've even heard chatter around the potential for calling off 20s entirely, or even reducing 30-year issuance in favor of boosting bill auction or 2-year auction sizes instead. Now, the line of questioning within the survey of primary dealers was far more focused on the potential to change the 7-year note to follow a refunding reopening schedule similar to 10s, 20s, and 30s, along with more detailed questioning around the future of the buyback program. So it's pretty unlikely that this cycle is going to be the one where we see any dramatic shift in terms of plans around long-end issuance. But nonetheless, between GSE buying of mortgages in the secondary market and the fact that even before he became Treasury Secretary, Besant was talking about the idea of changing the maturity profile of the market to encourage lower long-end borrowing costs, it's safe to say that refunding announcements have become far more tradable events under the Besant Treasury Department than they ever were under Yellen or Mnuchin.
And this is all occurring with a backdrop of geopolitical uncertainty running notably high, particularly following reports about an increased U.S. naval presence in the Persian Gulf. Now, clearly, there's been a lot of tensions in the Middle East, and this has left investors wary of a potential escalation of those tensions in the coming weeks. As with many things at the moment, this potential wildcard has left investors definitively on headline watch.
And whatever happens, if we've learned one thing, there is a clear winner in this market. And that's Burl Ives. He's been long silver and gold for decades now.
To be fair, if there were any precious metals to serenade, it certainly wouldn't be platinum and palladium.
More of a sky dweller man myself.
Yachtmaster for me. In the week ahead, assuming that there's not a partial government shutdown that closes the BLS, the market will have the benefit of the January non-farm payrolls figures. The consensus is for a 70,000 headline gain, with the unemployment rate at 4.4%. It's also notable that we do get the annual revisions to the establishment survey, so we'll have some confirmation of presumably even lower payrolls gains than were initially reported. In addition to the classic setup for payrolls Friday, it is a refunding announcement week, and there's been a great deal of chatter regarding whether or not the Treasury Department will retain the several quarters language regarding stability in coupon auction sizes. Our base case is that yes, the language is retained. However, given some of the language changes seen in the November refunding statement, we're open to the notion that it might be time to drop the several quarters language. In terms of some of the other details, there have been conversations about reducing 20-year auction sizes, although that is certainly not our base case, but nonetheless a risk as we consider how Besant might try to further contain any future backup in the longer end of the curve. We're looking for 58 billion threes, 42 billion tens, and 25 billion long bonds, all of which are unchanged, and our outlook is relatively consensus. As we consider the price action in the coming weeks, it's difficult to ignore the relevance of the labor data. The Fed has, to a large extent, made the future path of policy rates dependent on the evolution of the labor market. In the event that we have further stability or even an outright improvement in overall job gains, as the market is currently expecting, that will build the case to further delay normalization of policy rates. On the flip side, of course, a weaker than expected payrolls or an unanticipated spike in the unemployment rate will feed into expectations for a 25 basis point rate cut at the Fed's next meeting. In terms of the outright level of rates, we've been impressed with the ability of the 10-year sector to hover around 4.25, despite some of the potential bond bearish influences overseas, specifically as we watch the drama unfold in the JGB market, as well as the potential implications from a weaker U.S. dollar undermining demand for longer-dated treasuries and duration. That hasn't come to fruition, and if anything, we're characterizing these external bond bearish factors as limiting the ability of the long end to rally, as opposed to creating a new incentive for a sell-off. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. As January comes to an end, but winter clearly hasn't, we're reminded that there are two ways to make the winter fly by. Either skate, ski, and sled, or take out a big loan that's due on June 15th.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.
For full legal disclosure, visit bmocm.com/macrohorizons/legal.